Joining us now is Paul McCulley, former chief economist at PIMCO, currently an adjunct professor at Georgetown's McDonough School of Business. Thank you both for being here, for commenting. I want to get your perspective, Paul, because Steve just outlined his survey where he said, I believe the numbers, and correct me if I'm wrong, Steve, 66% said the Fed should cut, but 92% believe they will cut.
Yep, that's right.
So that's a pretty big distinction. How should we kind of distill that?
I actually agree with the conclusion of Steve's survey, and I also think very strongly that not only will the Fed cut 100 basis points in the months immediately ahead, but that it should. So for me, the numbers are the same. Will they and should they? And I think they should get down to about 3%, 100 basis points south of where we are, reflecting both the macro as well as what's going on in the market. From the macro perspective, clearly we've seen softening in the labor market, and we can talk about the reasons, but the bottom line is the labor market has softened and we have downside risks there. So the Fed, from a risk management perspective, should not be restrictive. It should be neutral. So I think that's the bottom line on the macro. And from the marketplace, the Treasury market, the SOFR market, has already discounted a 3% policy rate. So the Fed needs to validate what the market has already discounted in order to sustain the financial conditions, which are easier, but are easier on the presumption that the Fed's going to cut 100 basis points. So I think we have things in a pretty nice alignment right now.
Paul, I've already discounted being a billionaire and retiring, pretty soon. and that doesn't make it so.
That's the Fed fairy godmother, right?
Yeah, exactly.
You wish for it and then it happens.
Paul, my question is this. It seems like there is some division on the Fed, maybe not about cutting to your neutral point, because I think if you write down neutral as a Fed official, it means you sort of think that's where you ought to be, right? But there is some debate about the speed with which you get there. You said 100 in the coming months. The survey suggests 100 through the end of 2026. How cautious would you be about getting to neutral? And what is the signal the Fed sends by the speed with which it moves?
I think caution in these circumstances is defined by measured and predictable, and also, quite frankly, not terribly data dependent. So when I say the months immediately ahead, I'm thinking in terms of a steady march at each of the next 3 or 4 FOMC meetings of 25 basis points, and the Fed resisting getting wrapped around the axle. Should we do 50? Should we front load? And all of that sort of stuff. So I think that the issue of caution is to say without saying we're going to 3% in a measured sort of way, and do it without a lot of herky-jerky behavior. And for me, that is unlikely to reinforce negative psychology in the marketplace, or positive psychology if you're looking at it from the standpoint of bubble risk. So I think that steady march of 25s, which 100 basis points would be 4, so that would take you over the next 6 months, essentially starting with tomorrow.
So as we think about the other part of the Fed's mandate, which is inflation, I know that in that survey it was about 50%, 48% that believe the effect of tariffs have yet to fully work their way through. How concerned are you that easing into an unknown environment like that could backfire? And I ask that because Bloomberg had an editorial today which basically said the Fed should be pausing now because there's too much uncertainty out there with regard to all of these cross currents and all of these factors that they may have to pivot again in the future.
I push back really hard on the notion that the Fed should not be cutting here. That's a textbook sort of conclusion, as opposed to a conclusion based in the context of forward guidance being the sharp end of monetary policy. And forward guidance is already guided us to the notion of neutral, and the capital markets have taken it on board and put it into asset prices. So essentially, the notion that the Fed shouldn't validate the forward curve or the fruits of its forward guidance doesn't make sense to me. So I push back on that. From the standpoint of risk, notably on the inflation side, I'm generally a buyer of the proposition that the tariffs will be a staggered one-off effect, not a persistent and enduring inflation phenomena. And I also very strongly believe that the pass-through that is yet to come, and I think there's more to come, where corporations basically say, I can't eat it anymore in profit margins, I got to pass it along. It will show up as inflation at the consumer level, but I think it also takes real purchasing power out of the consumer's wallet. So actually, I'm more worried about downside risk on economic activity, notably consumer spending by the bottom half of the income distribution, than I'm about some sort of esoteric inflationary problem.